What's up, everyone, and welcome to the Daily Macro Update Live for Wednesday, April 16th. We have a lot of different macro data points to cover today, so we're going to go ahead and get right into it. As we go through this, go ahead and leave any type of questions that you have in the comment section below, and yeah, we'll be able to get to those after. All right, so taking a look at some of the recent headlines today, we have retail sales increasing in the month of March. There is a little bit of discrepancy for this. Of course, the headlines will show month over month change when really we want to see, although month over month change is important, what we really want to see is the year over year change. So we're going to be taking a look at that. There's some other stuff going on as well, but the main stream that we're going to be doing today is Jerome Powell is live at I think it's the Economic Club of Chicago. And we're going to be doing a bit of an analysis live on this meeting here that's coming up in about 22 minutes. And so we're going to be taking the next 20 minutes here to just go through a lot of the macro data, do the normal thing that we do for these daily macro updates, and then, go through some of your questions. And then after that, we'll go ahead and start the live stream and tune in here, and we'll be observing to see if Jerome Powell is, saying anything different, or if he's just saying, much of the same over the past several press conferences, which is they don't know anything. They are just waiting to see how the market reacts to these Trump tariffs to see if inflation actually accelerates or not, and then they'll take it from there. But it completely destroys the narrative that, the Federal Reserve is an entity that is proactive. They're absolutely not. They are reactive. And that was a huge, narrative over the past couple of years. And as confidence in the Fed starts to go down, that's really when uncertainty kicks up and we get into an environment like we are right now. And so we're going to be getting into that live later on when that starts at 1:30 p.m. Eastern time. All right, so taking a look at the S&P 500 here, we've been pretty cautious over the past couple of days as we've had this bounce on lower volume, which is a bearish divergence. Taking a look at the dollar, that does remain bearish as well. So, the market is pricing in that, cuts are coming soon. The 10-year bond yield continues to go lower here. So a lot of people were getting bearish on bonds right at the wrong time, and now it's having a bit of a bounce. Not yet reclaimed bearish trend, but it's on its way to do that. So interesting to see that happen there. The VIX tried to close below 30 yesterday, but again, we want to see this on a trending basis. VIX remains above 30, which means you really want to be careful with stock picking. Gold all-time highs, silver back to bullish. Bitcoin having another shot here. We'll see what happens. Bitcoin has definitely been having an interesting sideways action here. Usually this is signs of an accumulation, but we'll continue to see what happens there. It's still bearish in our model, but again, that could change depending on what happens from here. My team and I are typically just looking at Bitcoin as one of the large signals for what growth and inflation as well as liquidity expectations are going to do. But a lot different when looking at the Mag 7 stocks. Look at Apple, Microsoft, Nvidia, Amazon, Meta, even Berkshire is having a bit of a sell-off here. Broadcom, Google, Tesla, as well as JP Morgan, all of which still remain in bearish trend and potentially could have another leg down here. And so all the Mag 7 stocks, the market capitalization that makes up the most out of the S&P, those still remain in bearish trend. And so, yeah, that's what we're taking a look at here right now. Getting into some of the macro data, we talked about the headline here with, retail sales increasing. If we take a look at the year over year, not just the month over month, that also had an acceleration from 3.5 to 4.6% year over year. That is a decent acceleration, but this is also goods as well as food services, but there could be some speculation that a lot of this acceleration could be just from people purchasing things ahead of inflation expectations rising, right? So when there's a large expectation of inflation going up, people typically buy goods today before they expect prices to go up, right? That's a natural psychology of a buyer in the real economy. And so there could be some of that happening. But anyway, despite the reason why things go up, it is a positive growth signal there. And so part of what my team and I have been talking about is that if you start to get growth coming back and rebounding stronger, while at the same time we continue to see inflation going down, that could be a shift from this fearful scenario to more of a Goldilocks type of scenario. But when we take a look at let's see, auto dealers, other just retail trade also accelerated. If we just take a look at the control group, the retail sales control group, which is a large component of the Bureau of Economic Analysis's GDP calculation, you can see that this actually had a deceleration from 5.1% in February down to 4.6% in March. So when taking out a lot of the volatile components, retail sales actually slumped or, remained pretty much flat, since December. And so, those are the things that I'm looking at here. Getting into some of the other metrics that came out today, the Chicago Fed Financial Conditions Index, continues to ramp up. We haven't seen this type of acceleration since February of 2022, which was really near the start of the bear market of 2022. Typically, when this stops accelerating, that's a positive rate of change. And so, with this ramping up, you would want to see this, start to wane a little bit. But with this accelerating here, that's definitely risk off and added pressure on the financial system. This is kind of interesting here. This is business activity for the Federal Reserve Bank of New York. And this covers places not only with New York, but also New Jersey and other places within the area. And so business expectations continues to drop. Future business climate has gone down to its lowest level since the great financial crisis of 2008. So this is a horrendous drop, right, down to negative 50. Current business activity is still, remaining pretty much low and at the same levels as in March of this year. And, the last time it was this low was in October of last year, as well as January of 2023. I'm sorry, October of 2023, in January of 2023, and then the previous one was February of 2021. So business activity, having a bit of a slump there. Current business activity at the lowest level that it's been since March of 2021. Current prices paid continues to accelerate, although it has had a 1 month kind of slump here around 57, 58. So not too much of a change, but the prices paid continues to accelerate. Looking at the employment situation, that actually had an interesting acceleration over the past month here. But when we take a look at future employment index, you can see that fell all the way down to negative 5.4, which hasn't been that low since the lows of the pandemic. And so future employment looks pretty grim, according to the Federal Reserve Bank of New York. Future wages also has gone down. Again, these are all indices. This isn't necessarily hard data. This is all different Fed banks answering questions on a survey. So again, this is considered soft data. But typically soft data leads hard data. So, you want to make sure that you're paying attention to this as an early warning sign. So April 2025, that came down to 29.1, which we haven't seen that since around September and October of 2020. And that continues to decelerate for future wages. Heading on over to capacity utilization, though, this is more of a lagging indicator. And as you can see from here, this hasn't, dropped off just yet. But again, this typically drops as the recession is happening. So it's almost like a coincident / lagging economic indicator. And when you think of capacity utilization, you can pretty much think of it as business efficiency within manufacturing. So utilization of resources and being able to efficiently convert that into business activity. So you can just think of this as efficiency, but again, it's pretty much a lagging indicator. This is one of the last things that you want to look at. Or, you look at this as a time to buy the dips, right? So typically when this starts to really drop, that's usually the time when, hey, the market probably bottomed. This is, this is probably a good time to buy, but that hasn't dropped down yet. So in terms of a lagging indicator as a leading indicator for buying near the bottom, that has not happened yet. The housing market index, NAHB, this had a slight acceleration, but not too far higher than the March 2025 low, which the last time it was that low was in August of 2024. And then, if you kind of zoom out here, you can see that the housing market index remains fairly low, and there's no surprise there. I mean, rates are still pretty high. So I don't expect this to improve that much. Taking a look at the Fed meeting expectations, there's still nearly an 88% chance that they are going to remain paused during the Fed meeting on May 7th. We'll see how this changes depending on what we hear today from Jerome Powell's press conference coming up here in about 15 minutes. And then, in June, there's a 61% chance that they cut by 25 basis points. And if we go all the way down to the end of the year, as of right now, the highest probability, and it's almost a flip between a 100 basis point cut down to 3.25% to 3.5% Fed funds versus 3.5% to 3.75% Fed funds. So, that's still a decent amount away from where we're at right now. One of them is 100 basis points from where we're at. The other is 75 basis points. So we'll see what happens. The market is clearly trying to price in some of the risks that, we've been talking about here on this channel, but that's what the market is expecting here. And then again, what we're seeing here today is a speech from Jerome Powell at the Economic Club of Chicago. And we'll be tuning into this momentarily. It looks like it's going to be starting here in about 10 minutes. So we'll go ahead and tune in then, and we'll make sure that you guys can hear the rest of the audio there. Lastly, what I want to get into is the April 2025 Bank of America Global Fund Manager Survey results. Now, I did a video yesterday that goes into some of the charts, but I wanted to take this time to go into a little bit more in depth. And this was brought to this website here is hedgefundtips.com. And I would highly recommend you guys check this out. I mean, it's a decent free resource that gives you the highlights from these Bank of America Global Fund Manager Survey results. I am not an institutional investor or own a hedge fund, so I don't qualify. I also don't have over $500 million in assets under management. So I'm not sure if anyone here also has 500 million, but until that point, we'll continue to just try and look for resources online to give us these updates. But let's go through some of the main highlights here. I'll go ahead and blow up my screen here. Let's see if we can get this a little bit bigger. Okay. All right, here we go. So the first one here, when we take a look at the amount of investors that have growth expectations. This is at its lowest level since October of 2023. Global growth expectations fell to 1.8 in April from 3.8 in March. This current level of sentiment is the fifth lowest on record, behind 2001, 2009, 2019, and 2022. Interesting, because those were times when you know it was a great time to buy the dips in the market, right? So a lot of these signals can be taken as contrarian. So you can take that as good news or bad news, looking at these fund manager survey results. But I'm just giving you what it's showing here. Lots of uncommon data points. Here's one that I don't agree with, and I definitely think just based on looking at the data that the Fed is wrong here, right? So on inflation expectations, 57% of fund managers expect higher global inflation in 12 months' time. Now, it's our view that actually with growth and inflation continuing to decelerate, I mean, you look at a price of oil right now, that's obviously a headwind for inflation. So, we don't share the same inflation rising expectations that these fund managers do. We'll see what happens though, but we pay attention to the data, and they're just trying to collect their fee at the end of the year from the people who they manage their funds for. 42% say that gold is the best performing asset in 2025. Well, I mean, it should say 100%, because it is 100% the best performing asset so far in 2025. I'm not sure why only 42% say that. But second place, you have cash, government bonds. You can see that this right here is a lot more of a defensive stance and not so much an end of the world. An end of the world stance would be gold falling down to maybe third place, while cash and bonds, as well as any other cash equivalents, would have been higher on that list. But it's a more of a defensive stance right now by fund managers. Let's see. Let's take a look at sentiment. Most think that there's about 2 to 3 cuts. As we just saw, the market is pricing in 4 cuts as of this point. So, who's right, the fund managers or the bond market? We'll see what happens. The net percent of fund manager investors who see a strong global demand in the economy in the next 12 months has reached one of the lowest, or the lowest, on record. Hard landing expectations in April went up to 49% from 11% in March. Recession expectation rise to the 4th highest level in the past 20 years. So you can obviously see the pessimism here. And again, when it comes to these manager surveys, you can almost look at them as potentially doing the opposite of what these fund managers are feeling, right? Because just a few months ago, they had crazy expectations for performance in 2025, while the S&P 500 was pushing all-time highs. So that's pretty interesting there. April rotations are into bonds and cash, as well as utilities, healthcare, and staples. Here are the outflows. Same thing here, right? When taking a look at the record 2-month rotation out of stocks, we can see that this is I think this is the lowest. Yeah, it's the lowest level since May of 2023. And it looks like the second or the third lowest level since 2001. Tech allocations pull back to extreme levels. Really, the last time that tech stock allocation pulled back to these levels, it's only been twice so far. November of 2022, as well as 2007 during the great financial crisis. So, it could go lower from here, but it's getting to that point now where the standard deviation positioning in tech stocks is starting to go the other way, and is at 2 standard deviations below where it typically is. So that's definitely a signal to maybe start to think about different positioning here. So let's see. We talked about that. All right. So one thing that I also want to take note on is this cash position by these fund managers. So it's at 4.8%. If you guys remember from last time we took a look at this data, it was near 4%, which, as you can see here, there's two horizontal red lines on this cash allocation. One is at 5% and the other is at 4%. Anything above 5% cash allocation is considered extremely bearish and near the market bottom. And then conversely, anything at 4% or below typically signals market tops. Now, it's not a guarantee, of course. It's all just based off of historical data, and things vary over time. But what's interesting is that back in January of this year, that's when we saw this go down below 4% cash allocation for the first time since December of 2021 during the last market peak. So that's pretty funny there. And so as we see it rise, it's not quite yet at that 5% extreme level. It doesn't have to go up to that level, right? Like just how we saw back in 2004. We saw it go way above this back in October of 2022. I do expect this to keep on accelerating. So we're not at like peak fear in our team's view just yet, even according to the fund manager survey. So yeah, we still think that there could be some more further downside going on from here. The most crowded trades, long gold and still long mag 7, about 24%. But this long gold allocation broke a 24-month streak of consecutive long mag 7 crowded trades. So this is the first time that it's not the most crowded trade since March of 2023, that being the mag 7. And then let's see, don't really care about that. So yeah, fifth most bearish survey in the past 25 years, fourth highest recession expectations of the past 20 years, and there's a record number of global investors attending to cut US stocks. That is the main message from this global fund manager survey from Bank of America. So yeah, as you can see, fund managers are starting to get to bearish extremes. Now, again, this is just survey. It's more soft data, but you have to look at the historical importances of where this survey is located at points of extreme. And I think we're very close to that. I'm not trying to call a bottom in the markets, but you can pretty much make an educated decision on that we're closer to the bottom than not, right? So we just have to see what happens from here. The bookshelf is still the color red, and so our model is still bearish on the S&P 500. Still not a signal to buy in our model just yet, but that's what we're seeing here. And I forgot to mention, as we were looking at retail sales numbers increasing, right? Specifically, the auto and vehicle dealers see this huge acceleration. Well, it coincides with supply falling, right? So a lot of people are doing these purchases ahead of a lot of tariff effects going into play. And I think I was listening to some financial podcast where there was someone who owned like a Lexus dealership, and they said that in March they had their best year since before the pandemic in terms of Lexus sales, because of people were like, okay, a Lexus is about to go up like 20% or something soon, so we better buy it now. And so this premature surge in sales, you would have, if you really want to see this as a sign of growth, coming back to life, you would need to see multiple months of that, typically 2 or 3 or more. And so this is just 1 month. We got to see if it carries over. All right. So let me go ahead and try refreshing this to see if this pops up. Let's see. As this loads here, we can go ahead and answer any one of your guys' questions here as we wait for that. Real David Thurston, no problem, man. Always happy to share. Gold, crowded trade equals high volatility and quick drop potential. Yeah, possibly. Do you see Bank of America mentioning that investors should be shorting the S&P? No, it doesn't say that. It just shows, positioning, bullish or bearish. Did the Fed speak today yet? No, not just yet. It looks like it will be starting here momentarily. Yeah, let me just check to see a couple more other places here. No, definitely not happening yet. Let me just make sure. All right, so we're still on track here. We'll wait for this to start. Make sure the volume is up so that we can hear. All right. Yeah, so if you guys want to put in tickers, I'm more than happy to answer those questions. Thanks for all you do. Appreciate your knowledge and wisdom. No problem. I mean, it's a continuous learning. All I'm doing is essentially whatever I'm learning for the day, I'm just telling you what I'm thinking. And but there's a lot of stuff that I need to learn still. It's going to be a lifelong process of learning financial markets. Do you see us going into a recession in the second and third quarter? I don't just yet, only because when you take a look at some of the spreads for the banking sector, you can see that there's not much stress, although it is starting to accelerate a little bit here. You're not necessarily seeing too much interbank stress. Um, so, yeah, really what we're seeing is, how we just saw the inflation expectations go super high. Look at what the 10-year break-even inflation rate is doing. It's doing the opposite of what all these people are expecting inflation to do. So the chart math is in agreement with what we are seeing as well with inflation. So yeah, I'm not sure. I think that Wall Street is a little bit off sides there with expecting inflation to just go crazy. Who knows? Maybe it could happen. I don't know. But that's not what we're seeing currently. So yeah, I mean, we're not seeing too much financial stress in the markets right now. So if you're not getting banking stress and lending stress just yet, then I wouldn't see this as a crazy um, recession call. But yeah, that's not what I'm seeing currently. What's your estimation on when QE can start? Foxrun.am. Why do you ask that question? How much course study did you drill into yourself prior to managing any real money in the markets? Well, I've been messing around with stocks and crypto for quite a long time, and so there's a lot of trial and error there, as well as myself like paying for different online courses and stuff like that, making a lot of mistakes, and then just realizing that there's a better way to do it through risk management, and yeah. Lots of money lost, lots of money gained, but within that, the experience level continued to go up. Any thoughts on United Health heading into earnings? Let's see. It's definitely at the top end of the range. I wouldn't be chasing here, but you know, it's had this huge jump on lower volume. So yeah, I probably would not be buying here. I'm just wondering if we need QE to stabilize the bond market. No, I don't think so. QE won't come into effect unless like the world's on fire. Do you think another '08 financial crisis is less likely to happen? Oh, here we go. We'll get into it here momentarily, but it looks like this is starting. So let's see.
Others joining us
Let me know if you guys can hear
from
this.
around the country are a testament to the importance and the timeliness of today's topics and speaker. Today, we have the great privilege of hearing from the Honorable Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Today's a little special, so out of respect for our speakers, and because we're broadcasting this program live, I would ask that you please remain seated and quiet during the program so that we all can gain the full benefit.
All right, well, she's doing the introduction. Let me just answer a couple of these questions here. I don't think that another 08 financial crisis is likely at this point in time. I mean, there's still like a large contagion that's out there that could happen with the Eurodollar market, but you know, it just depends. But as of this time, I don't see that happening, just yet. Let's see. Do you think the VIX looks like there's another spike coming? Possibly. I mean, with it above 30, really anything can happen right now, and you do want to be very careful.
Professor at the University of Chicago Booth School of Business, Dr. Raghu Rajan, the Catherine Dusick Miller.
That's not Jerome Powell. Let's continue with questions. But with lower rates as low down in QT and tariff risk, don't you think Wall Street could be right about inflation? But with lower rate as low down, I'm not really sure what you mean, FFX, on that question there. Maybe if you can, are you asking that tariff risks as well as them decelerating quantitative tightening? No, that doesn't mean that inflation is going to continue. We'll see, though. All right, is this guy done?
And then our featured speaker will be Jerome Powell, the 16th chair of the Board of Governors of the Federal Reserve System. As head of the U.S. Central Bank, as you know, Chair Powell plays a crucial role in the country's monetary policy. Major financial institution bank, as you know, Chair plays a crucial role in monetary policy. 16th chair of the board. Welcome to Professor Rajan.
Was there someone talking before him?
Economic and financial stability team, and then renominated to his post by.
If there's someone talking before him, then what I might do is because I don't have time all day today, I was basically going to do this until about 2 p.m. because I have other meetings I got to get to. But yeah, we'll see what happens from here.
Fed has been a steady hand and one of the all-time greats.
Isn't it crazy how they have these like conferences where like they're just sniffing each other's butts the entire time?
At the Treasury Department under President George H.W. Bush, with responsibility for financial institutions, the Treasury debt market, related areas. Outside of public service, Chair Powell has worked as a lawyer, an investment banker, and been a partner at the Carlyle Group. In addition to his service on corporate boards, he served on boards of charitable and educational institutions, including the Bendham Center for Finance at Princeton and the Nature Conservancy of Washington, D.C. and Maryland. He is a D.C. native, received a BA in politics from Princeton, and a law degree from Georgetown University, where he was editor of the Georgetown Law Journal. Please welcome to the Economic Club of Chicago again, Chair Jerome Powell.
I guess he is speaking. Great. I can't, unfortunately, pull up a chart at the same time. I wish I could, but unfortunately, I can't.
Thank you and good afternoon. It's great to be back in Chicago.
Purple tie, sell
Thanks
it.
for that kind introduction,
Just kidding.
Austin. So I'm looking forward to my conversation with Professor Rajan Raghu. But first, I'll briefly discuss the outlook for the economy and monetary policy. So at the Fed, we are always focused on the dual mandate goals that Congress has given us: maximum employment and stable prices. Despite heightened uncertainty and downside risks, the U.S. economy is still in a solid position. The labor market is at or near maximum employment. Inflation has come down a great deal, but is still running a bit above our 2% objective.
A bit above.
Turning briefly to the incoming data, we'll get the initial reading on first quarter GDP in a couple of weeks. The data we have in hand so far suggests that growth has slowed in the first quarter of this year from last year's solid pace.
Yeah, it's negative now.
Despite strong motor vehicle sales, overall consumer spending appears to have grown modestly. In addition, strong imports during the first quarter, reflecting attempts by businesses to get ahead of potential tariffs, are expected to weigh on GDP growth.
Yeah.
Surveys of households and businesses report a sharp decline in sentiment and elevated uncertainty about the outlook, largely reflecting trade policy concerns. Outside forecasts for the full year are coming down, and for the most part, point to continued slowing, but still positive growth. We are closely tracking incoming data as households and businesses continue to digest these developments. In the labor market,
How's
during
everyone
the first
digesting
3
these
months of this
developments?
year, non-farm payrolls grew by an average of 150,000 jobs per month. While job growth has slowed relative to last year, the combination of low layoffs and lower labor force growth has kept the unemployment rate in a low and stable range. Meanwhile, the ratio of job openings to unemployed job seekers has remained just above 1, near its pre-pandemic level.
Hiring freeze.
Wage growth has continued to moderate while still outpacing inflation. Overall, the labor market appears to be in solid condition and broadly in balance, and is not a significant source of inflationary pressure.
Even though he tracks U3 numbers,
As
that doesn't
for our
count
price
for
stability
the
mandate, inflation has
economy.
significantly eased from its pandemic highs of mid-2022 without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. Progress on inflation continues at a gradual pace, and recent readings remain above our 2% objective. Estimates based on the most recent data from last week show that total headline PCE prices rose 2.3% over the 12 months ending in March, and that excluding the volatile food and energy categories, core prices rose 2.6%. Looking forward, the new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. These policies are still evolving, and their effects on the economy remain highly uncertain. As we learn more, we will continue to update our assessment. The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs.
I can't blend in a chart.
Survey measures of longer-term inflation expectations, for the most part, appear to remain well anchored as well. Market-based break-evens continue to run close to 2%. So, as we gain a better understanding of the policy changes, we'll have a better sense of the implications for the economy and hence for monetary policy. Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. As that great Chicagoan Ferris Bueller once noted, life moves pretty fast. For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks. We understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. We will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to our discussion.
Yeah, but he didn't say anything different. I mean, he doesn't know anything.
Thank you very much, Chair Powell, for those remarks. I look forward to your elaborating on them in the course of the next 40 minutes or so. I understand last time you were here, Melody Hobson interviewed you. Well, I'm a poor substitute, but I'll try and compensate in the quality of the questions. As you repeatedly emphasize, communication and transparency are very important for the Fed. I would like to get more from you on some of what you just said. As a former central banker, the only sort of caution I've been given by the Economic Club is to not lapse into central bank speak. So I'll try my best not to do that. Let me start by saying you've guided the Fed through some really difficult events, including the pandemic, the dash for cash in March 2020, the great inflation, the banking crisis centered around Silicon Valley Bank. And then over the course of the last year, we've seen a growing possibility of a Fed-engineered soft landing. And now it seems like everything has changed. In the course of a couple of months, JP Morgan has
How could the central bank get it wrong?
to estimating the probability of a recession this year at around 60%. What do you think about all this?
This guy is like complete Wall Street.
First of all, thank you for being here today. It's a pleasure to be here with you. Actually, the appearance I did here was my very first appearance as chair 7.5 years ago. So it's great to be back. And I would agree with you that it's been an eventful 7 years. Putting it mildly, I keep waiting for the 3 months of calm, that never comes. But to your question, I guess to set the stage, let's look back at 2024. 2024 was a year where the economy grew 2.4%. Unemployment remained in the low fours, close to mainstream estimates of maximum employment, and inflation came down and was running at the end of the year around 2.5%. That's the economy that we had, and I won't decide how to characterize that, but that's where things were. Where we are now, again, to your question, is the administration is, as I mentioned in my remarks, is implementing significant policy changes, and particularly trade now is the focus. And the effects of that are likely to move us away from our goals. So
S&P down 200
unemployment is likely to go up as the
points.
economy slows in all likelihood, and inflation is likely to go up as tariffs find their way, and some part of those tariffs come to be paid by the public. So that's the strong likelihood. And my hope is that we'll get through this and get back. Well, we're always going to be aiming for maximum employment and price stability. That's what we do. I do think we'll be moving away from those goals probably for the balance of this year,
Oh
and
man.
then, or at least not making any progress, and then we'll resume that progress as we can.
Let's talk a little more about tariffs.
So he
I
basically
mean,
said, yeah,
recognize that
we didn't
some
cut
of the
enough,
effects of the
or we
tariffs
didn't
will be
hike enough.
one-off, transitory.
Why were they
But
cutting
you
back in
also
September?
have said that perhaps they will give room
Makes
for
no
a number of
sense.
firms to raise prices. You mentioned dryers. When washing machine prices went up because of tariffs, dryer prices also went up in tandem, even though they weren't tariffed. What's your sense about the effects of tariffs on inflation? What would make them more persistent, and what would make them have effects on growth?
So in a kind of a simple starting point is one tariff comes in that gets passed along in prices and raises inflation, but it's just a one-time thing. So the price level goes up and that's it. But that can happen in some circumstances, but it depends on a number of things which we don't know yet. And I would point to a couple of them, or three of them actually. One is just the size of the effects. And as I mentioned, the tariffs are larger than forecasters had expected, certainly larger than we expected, even in our upside case. We looked at a range of cases. So that's one. The second one is how long does it take for the tariffs to have their effects on inflation? To the extent it takes longer and longer, that raises the risks that the public will begin to experience higher inflation. They'll come to expect it, and companies will come to expect it. So that risks higher inflation. And the third is just what I mentioned in my speech, which is my remarks, which is got to keep inflation expectations well anchored. So if we have those three things under control, that's what it will take. And indeed, our role is to make sure that this will be a one-time increase in prices and not something that turns into an ongoing inflation process. That's a big part of our job.
What about the effects of tariffs on quantities? With the level of tariffs that, for example, have been currently applied
Nvidia
to
is
China,
down
there's a fear
8.5%
that the
today.
supply chain may get disrupted, that firms may not be able to import their relevant stuff from China given the level of prices. If it turns into a supply shock, would the Fed's response be different than if it was primarily something which affected just prices?
So I actually had dinner at the Chicago Fed last night, and with a number of directors of various parts of the Chicago Fed, and many of them are CEOs of significant companies, and they this uncertainty that they're feeling and the issue with imported components to their products is just a huge issue. But with if you look back at the pandemic, if you remember, there was a shortage of semiconductors, and that led to a shortage of cars at a time of extremely high car demand. And it was a prolonged shortage because production couldn't keep up. And that led to an extended period, one of the things that led to an extended period of inflation. So when you think about supply disruptions, that is the kind of thing that can take time to resolve, and it can lead what would have been a one-time inflation shock to be extended, perhaps more persistent, and we would worry about that. In this case, you can look at the car companies, which their supply chains are likely seem to be on track to be disrupted significantly, and you would worry that that process will take some years and that the inflationary process might be extended. So these are all of this is highly uncertain. We're thinking now really before the tariffs have their effects, as how they might affect the economy, and that's why we're waiting really to see what the policies ultimately are, and then we can make a better assessment of what the economic effects will be.
Let's move to immigration. You talked about.
Let me just pause here for a second, because what Jerome Powell was basically describing was the supply side inflation that happened because of the pandemic, and he basically just admitted that partially why inflation came back down was because supply chains from the pandemic came back into, came back to normal essentially. And so, it's also like, okay, if the Fed is raising rates and becoming more restrictive, their policies can only affect demand side inflation, right? Because you have two different types of inflation. You have demand inflation as well as inflation, or I'm sorry, supply side inflation. I think it's like cost push versus demand pull. I believe, are the two. And so all that the Fed can affect is demand pull inflation. They have no influence on supply chains or anything like that, direct influence. And so with them seeing like, okay, all these tariffs are most likely going to affect the thing that we can't even influence, that's why they are staying incredibly cautious of what's happening from here. And that's partially why they think that inflation is going to go up, because they're looking at what's happening. But at the same time, demand is also weakening fairly quickly. And so what happens is from here, if you don't have people buying as much and you're getting price increases from tariffs, where are those price increases going to be? They're going to remain on the supplier's side, meaning that a lot of the potential inflation from tariffs are going to eat away at corporate margins instead of price increases, in front of people like you and I, regular consumers. Because again, people are cutting back on spending. Demand is going down while input prices are rising. That's a sure way of seeing that margins are going to compress, which is, partially why I think, you're seeing a large decline in the S&P 500 and the Mag 7 stocks. But we'll go ahead and continue.
Being in reasonable equilibrium right now. Of course, what we've seen over the last few months, months of the previous administration continuing into this administration, is immigration has fallen off considerably. What's your sense on how that will affect the labor market?
So part of why growth was so strong in the last couple of years was just very high levels of immigration, and those people went to work. The economy hired them. There was a lot of demand. We were still working off the labor shortage. What's happened since the prior administration changed their policy, as you mentioned, immigration has fallen very sharply, and therefore the growth of workers has really stopped. It's really stagnant. But at the same time, demand has also fallen. And so demand for workers, so payroll job creation has also fallen, and they've kind of fallen in tandem, which is why the unemployment rate has been pretty stable for about a year. So in a way, demand and coincidentally, perhaps to some extent, demand and supply for workers has fallen. In terms of the effect on the labor market, right now we're still at full employment. And labor force participation is still strong. Wages have moved back down to levels that are now pretty sustainable, given an assumption about productivity. So the labor market's in a really good place. Longer term,
No, it's
the
not.
effects of immigration are not thought to matter much for inflation. The effects on demand and supply will more or less cancel each other out. So we wouldn't expect there to be a big impact on inflation.
You've seen in recent weeks substantial talk about layoffs in government, as well as freezes in research establishments and universities in jobs. How soon and how big will this be in its impact on labor markets?
So it's too soon to say, but what I can say is, of course, the people being laid off in government, this is highly significant to them. We don't know how big that's going to be. Right now, it's not big enough to affect a workforce of 170 million people materially. In terms of the cutbacks in funding and for science and things like that, we do see in areas, particularly in cities that have a lot of universities and research hospitals and research institutions, we're really hearing significant layoffs and significant impacts on employment. I don't know how much that will total up to. And of course, in addition, cutting back on scientific research may have implications for economic growth, for productivity, for health, for all kinds of things. But those are very difficult to estimate in real time.
Now, given that we're talking about the future, you may be confronted in the not so distant future with both higher levels of unemployment as well as potentially higher inflation. And of course, the policies that each one requires could be different. You talked a little bit at the podium about how the Fed would see these two and how it would address it. Just giving you a chance again to elaborate on that.
Right. So most of the time, when the economy is weak, inflation is low, and unemployment is high, and both of those call for lower interest rates to support activity, and vice versa. So most of the time, the two goals are not in tension, and they're not really in tension now. The labor market is still strong, but the shock that we're experiencing, the impulses we're feeling, are for higher unemployment and higher inflation, and our tool only does one of those two things at the same time. So it's a difficult place for central banks, to be in terms of what to do. And so the best we can do is we actually have a little provision in our consensus statement, which is the thing that we vote on to embody how we approach these questions. What we say is we will look at how far the economy is from each of those two goals, and then we'll ask, might there be different paces at which they would approach those goals? We'll look at those things and think about them, and we'll make what will no doubt be a very difficult judgment. Again, we're not experiencing that now, but we could well be in that situation, as I mentioned in my remarks.
The Fed has no
I
model.
just want to
Jerome
pick up
Powell has no
on
clue
a
what he's doing.
word that is often used today, uncertainty. As a respondent to a Dallas Fed survey said, I've never felt more uncertainty about my business in my entire 40-plus years career. The worry today is not just about immediate policy uncertainty, but an entire change in the US's economic philosophy. Not just policy uncertainty, so to speak, but structural uncertainty. One of the effects, as you've pointed out, of higher levels of uncertainty is that firms postpone investment. For instance, even after the tariffs stabilize, firms that contemplate reshoring production facilities will hesitate, not knowing if the tariffs will be reversed in the future, maybe by the next administration. How do you take such longer-term uncertainty into account in your policies?
Let me just agree that what comes back very strongly, and everyone will understand this. These are very fundamental changes in, long held in some cases, policies in the United States, and there's not any real experience. I mean, the Smoot-Hawley tariffs were actually not this large, and they were 95 years ago, so there isn't a modern experience of how to think about this. And businesses and households are saying in surveys that they are experiencing incredibly high uncertainty. There's a lot of research, some of it from the Fed, showing that does lead to businesses and households stepping back from decisions, which of course makes common sense. And you hope that that's something that you go through a phase, and then you know what things become more certain, and therefore people can resume normal economic activities given their understanding of what is the new normal. I mean, your question really is, what if the uncertainty remains high? I think that's a difficult environment. I think people's expected rates of return would have to be higher. I think that would weigh on, to me, investment just in general. If the United States were to become a jurisdiction where risks are just structurally higher going forward, that would make us less attractive as a jurisdiction. We don't know that at this point, but I think that would be the effect.
Well, let me turn to financial markets.
Bitcoin is starting to turn over too.
Some volatility, especially stock market volatility. I mean, the levels of the VIX are up to the levels they were in the early days of the pandemic, coming off somewhat now. Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. So what I think is going on in markets is markets are processing what's going on, and it's really the policies, particularly the trade policy, and really the question is, where's that going to come in? Where's that going to land? And we don't know that yet. And until we know that, you can't really make informed assessments that would still be highly uncertain. Once you know what the policies are, it'll still be highly uncertain what the economic effects will be. So markets are struggling with a lot of uncertainty. and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation. Markets are doing what they're supposed to do. They're orderly and they're functioning just about as you would expect them to function.
So we've
selling
seen
off
volatility also
and
in the
crushing
bond
people that
market.
bought in
And at a
as we were
time
saying everything
when
was fine
usually
2 months ago.
there's a flight to safety, we saw yields on the German Bund and the Japanese government bond come down, but we saw yields on US Treasuries go up. What do you attribute this to?
So I would just say the same thing. I think it's very hard to know in real time. I've had a lot of experience with significant moves, for example, in the bond market, where there's a narrative that people land on, and then 2 months later you look back and go, that was completely wrong. So I think it's very premature to say exactly what's going on. Clearly, there's some delevering going on among hedge funds in levered trades and things like that. It's also, again, it's the markets processing historically unique developments and with great uncertainty. And I think you'll probably see continued volatility. But I wouldn't try to be definitive about exactly what's causing that. We'll just say markets are orderly and they're functioning kind of as you would expect them to in this time of high uncertainty.
I do agree with that.
So,
The reason why
the
really
Fed
doesn't
in
matter
its
when all we're
last
trying to do
meeting
is make
slowed
money.
the pace of shrinking of its balance sheet. Was this driven by uncertainty about how much reserves and liquidity the market needed, and you wanted to take a little more time to find that out? And flip side, you said the market was orderly. What if market disruptions emerge? Would the Fed intervene?
So we think that reserves are still abundant. So we don't think we're close to the point, particularly close to the point where we would stop. But we were facing a situation in which, for other reasons, there were going to be big flows into and out of reserves as it had to do with the debt ceiling and the Treasury General Account. For those of you who are Treasury market people, that'll make sense.
Dylan, nice.
While those big flows are happening for over a period of 6 months, we would actually be shielded from being able to see evidence that we were or were not getting close to the
Fast
level
forwarding
of
it just
less
a bit
abundant
to
reserves.
get us
And so we
back up
decided
to
to slow
speed.
the pace. We thought about pausing, and instead we debated. It's one of these great debates that we have at the FOMC. We decided to slow the pace instead, and people really came to see the merits of that because the slower we go, the less the smaller the balance sheet can get without disruptions. And we want that process to continue. And now it's at quite a slow pace. So we think that's a really good thing. So that means we can go on for a longer amount of time, and we'll be able to reach kind of very carefully what we think is the right level of reserves. Still
The right level of reserves.
What about the
$6 trillion,
international dollar-based
Jerome?
system? With all these disruptions, do you stand ready to supply dollars to central banks as you've done in the past when there's been a global shortage of dollars?
Sure, absolutely we do. Just for everyone's knowledge, we have standing dollar swap lines with 5 large central banks, and they go to the jurisdictions where there are big overseas dollar funding markets. And in effect, those are overseas markets where, for example, a European or Asian institution is buying an asset-backed security that is backed by loans to American consumers. So in effect, these are loans to American consumers, and we support that. We want to make sure that dollars are available. They need dollar funding to hold those dollar assets. So the way it works is, when needed, we lend to the central bank in dollars, and they pay us back in dollars. They then pay in their currency. They lend on in dollars, and so we take no credit risk or anything like that. And it supports dollar funding markets. Dollar funding markets are very sensitive during times of crisis, and it's very helpful. The reason we do it is it's really
You're referring to
good
the
for
euro
US
dollar market.
consumers. So we'll continue to do that, just as part of the dollar.
But they don't have any control over that.
Most important, and
it's outside of the United States jurisdiction.
You mentioned amongst the issues you were focused on was the U.S. fiscal situation. Well, clearly, U.S. sovereign debt continues to rise, and what are your thoughts on the longer-term implications for interest rates and economic stability? How much further can we go in terms of national debt before we cross a line that might be unsustainable in the long term?
So the U.S. federal debt is on an unsustainable path. It's not at an unsustainable level, and no one really knows how much further we can go. Other countries over time have gone much farther, but we're now, we're running very large deficits at full employment, and this is a situation that we very much need to address. Sooner or later we'll have to, and sooner is better than later. In terms of, if I can say from my time working on these issues, it's not the Fed's issue, but if you look at the pie chart of federal spending, the biggest parts and the parts that are growing are Medicare, Medicaid, Social Security, and now interest payments. And so that's really where the work has to be done. And those are issues that can only be touched on a bipartisan basis. Neither party can figure out what to do without both parties being at the table. So that's critical. All of domestic
Bipartisan.
discretionary spending, which is essentially where 100% of the conversation is small as a percentage of federal spending and is declining it's already declining as a percentage of federal spending. So when people are focusing on cutting domestic spending, they're not actually working on the problem. Domestic discretionary spending is already going down. I like to make that point because so much of the dialogue that the politicians offer is about domestic discretionary spending, which is not the issue.
Well, let's turn to stability and regulation. Turning to the U.S. financial sector, we still have some concerns about distressed commercial real estate loans on bank balance sheets, whether they.
So real quick, when he's talking about the federal deficit, I do agree that most of the spending is by spending that the government has to do by law. So it's not discretionary spending that they can easily cut. It's spending on Medicare, Medicaid, Social Security, and those things. It's a very long and crazy process in order to reduce that, and people get very upset. And it's also one of the ways that the government makes a lot of money is by doing that. And so with that, he's kind of saying, yeah, we don't really see government spending slowing anytime soon, and it's going to continue getting worse. And so for us who are investors, there's really, until this whole thing, goes up in flames, Roman Empire style, pretty much we have to invest as if inflation as well as the money supply is going to continue going higher because the government is just obsessed with borrowing because they have way too much to spend. So he is correct in that we don't know where that unsustainable level is. It's currently on an unsustainable rate of spending. But until Congress actually goes in and touches some of that spending that is mandatory, you're really not going to see any reduction in that.
They've been fully dealt with so far. There's some sense that they haven't. Add to that the very rapid growth in various forms of private credit over the last few years, which arguably haven't been tested by a full-blown recession. How would you put the resilience of our financial institutions at this point and their ability to weather potentially uncertain times?
So I think our banking system is well capitalized with liquidity and is quite resilient right now to the kinds of shocks that it may face. I do believe that. In terms of the commercial real estate,
which we saw earlier,
and this has been the case, really, we've been working on this for 4 or 5 years now. There are some banks, it's mostly medium and small size banks who have elevated concentrations of commercial real estate, some of it troubled, and we've been working to make sure that those banks have a plan, have capital, and can absorb the losses that they're doing. So, and that's been going on for some time. The very largest banks don't tend to have high concentrations. So this is a problem that we have known would take years to work through, but we're really well into the process of working through it. In terms of the non-bank financial sector, it's grown enormously. The provision of credit by non-banks has grown just really fast. Most of it has been funded, though, with a private equity-like structure where it's limited partners who are signed up for 10 years to a general partner to invest that money. They're not depositors who can run. Your money's committed. And so that funding model is kind of run-proof. That isn't some law of nature, though. So when you do start to see shorter-term funding creeping in, to your point, though, Raghu, this very fast-growing and now quite large private credit part of the economy has not really been through a significant credit event or it's really grown since the pandemic. And so just for that reason and for how fast it's growing, we have a close eye on it. It doesn't have the same kind of prudential regulation, though, that the banking system has. So we're watching it carefully. And as I mentioned, it's a more stable funding source to the extent its institutional investors signed up for a long period.
They'll probably just print money like in the
my,
regional banking crisis
banking
if anything happens.
Actually, banks are also involved in funding these institutions in a big way.
Yeah.
We do know the administration wants to relax regulations in many areas, one of which may well be banking. What can you tell us about the Basel III endgame, so to speak, which is, at this point primarily focused on additional capital for the large banks?
The Fed view, and my view, is that we should proceed to complete the Basel III accord, and we would have to do that, and would look forward to doing that in conjunction with the FDIC and the OCC. But our view is, and I think the bank's view as well, is we should complete that. You need international minimum standards. That's kind of a common good. And we're not bound by them. Really, nothing. The United States has plenty of input into what those accords contain. So our view is strongly that we should complete those, and we could do it, I think, relatively quickly. We're not so very far away from what would be a good, I think, outcome.
Well, let me move to something which is more
Basel III is just
about technological change and
another way
kinds
of money
instruments.
printing.
Cryptocurrencies. How do you see the potential for more favorable regulations coming on them, and potential risks from that for the system?
So we went through a wave of failures and fraud and things like that were the headlines for a couple of years. And I think what you see now is, and during that period, by the way, we worked with Congress to try to get a legal framework for stable coins, which would have been a nice place to start. We were not successful. I think that the climate is changing, and you're moving into sort of more mainstreaming of that whole sector. So Congress is again looking at both the Senate and the House are looking at a legal framework for stable coins. Depending on what's in it, that's a good idea. We need that. There isn't one now. And stable coins are a digital product that could actually have fairly wide appeal and should contain consumer protections of the typical sorts and transparency. And that's what the Senate and the House are working on. So that's a positive thing. I also think some of the, we took a pretty conservative, and other bank regulators took an even more conservative perspective on the guidance and rules we imposed on banks. I think there'll be some loosening of that, and I think we'll try to do it in a way that preserves safety and soundness, but that permits and fosters appropriate innovation, but that does so in a way that again doesn't put consumers at risk in ways they don't understand or make banks less safe and sound.
You have a policy review underway. Now, surveys recently tell us there seems to be a distinction between a rise in the level of prices, which is what the public seems to worry a lot about, and the rate of increase in prices, which certainly they worry about in passing, but the Fed worries much more about. That is the rate of inflation. So even though we're coming down to 2%, people remember that over the last few years, it's been over 20% increase in prices. So as you start thinking about the policy review, is there any thought about how you might want to address this sort of challenge, that it's the path of prices as much as the rate of change which matters?
First of all, I think you're right, and I think the public is right. When we say inflation is back down to 2%, 2.5%, and we think that's a good thing, it is a good thing. But if you're paying 20% more than you were paying in 2021, that doesn't help you much. You're still paying a lot more than you used to be paying for the necessities of life. So it's just another way of saying people hate inflation, and it's easy to understand why. All we can really control is a world in which, in the world we were living in, prices don't go down in the aggregate except in extreme times that we don't want to court. So I don't think we couldn't have a framework where we're going to bring prices down by 10% or something. That's not something we'll be looking at. We're essentially looking at the best way to foster 2% inflation over time. And the things we did back in the changes we made in 2020 were really innovations around what to do when you're stuck near zero. Now we're well above zero, and it may be that we still need to have in our framework a way to deal with that, but perhaps the main case is not one where you're dealing with the effective lower bound, and that would be a framework that looks a lot more like the one that we had before 2020.
Now, one of the tools you brought in to deal with the zero lower bound was quantitative easing. But you've also used quantitative easing to fix disruptions in the financial markets. Are you going to be more specific about what your objective is with quantitative easing as you go through this review?
So in the beginning, it's typically we're using it for financial market function. That was the case with the global financial crisis and with the pandemic. And we did try to explain ourselves through the pandemic. And our explanations did change, but I think it's fair to say we might have done a better job of being clear about why we were doing it. And that's something that we're aware of and looking at.
No discussion is complete without talking about AI.
Yeah.
With AI coming fast and furious, it could affect productivity, it could affect employment. There are some people who say we will see for the first time technological unemployment in a serious way with AI. What are your thoughts about it, and how will it impact the Fed going forward?
So like everyone who's been exposed to what it's capable of, it's beyond, I started thinking about it as like a better version of Google, but it's not. It's like a better version of a person, I mean, it can do amazing things. And so the question is, all through the 250 years of technological innovation, technology evolves and people worry that it's going to replace human labor and people will be unemployed. And that's not the case. It may be the case in the short run, but in the long run, what it's done is raise human productivity and therefore living standards. So is this going to be the case where it eliminates more jobs than it creates? And we just don't know. I mean, you come back in 20 years, will it be the case that just people are much more productive in their work because of AI, or will it be the case that AI has just replaced a lot of people? And I think it's very hard to say, but it truly is remarkable in what it's capable of. And it's you know, we had a demonstration by a Wharton professor recently, and you speak to it like it's a person, and it kind of responds like a person, and the things that it can do are really amazing. So, and by the way, this is early days. You know, they're talking about even the next couple of years will bring more dramatic breakthroughs. So I think it's one of the 2 or 3 things most likely to bring dramatic change to the economy all around the world in the next 20 years. And I'd say very hard to say how it shakes out.
Let me turn to your job. An important man once said of your job, it's the greatest job in government. You show up to office once a month and you say, let's see, flip a coin. And then everybody talks about you like you're a god. What is it that you normally do every day in the office? Is it fulfilling and, dare I say, enjoyable? And do you really feel like a god?
So I would agree. I think it's the best job in government. I would agree. I really do enjoy it. Yes, I love the job. It's a great honor to serve.
It's not government.
It's quite humbling because
it's not a government job. The central bank is a private entity.
So all of that is true, and I do what everybody expects me to do. We do a little more reading though as part of our daily. My colleagues and I do part of our daily regime than a typical executive would do. In terms of being a god, I would say that we are blessed with a large number of amply compensated critics who would kind of tend to undercut that. So we don't feel like a god.
So let me go to the more mundane. In that office,
yeah, it is giving Hunger Games vibes.
What are the key?
And he was laughing at it. He liked the compliment
that you go to as you try and make up your mind.
So I'd say start with labor. There's more labor market data and better reliable labor market data than probably anywhere else. And it's just a lot of data. And it's new jobs, it's payroll, it's wages, it's participation. You can break all of those down in different categories. It's a million different things. So there's a lot of labor market data. It's a great field if you're going into economics because there's just so much to do. So then we look at the inflation data. Also, I keep track of global developments pretty carefully, and I talk to my global counterparts pretty regularly just to stay aware of what's going on. Financial markets are really important, and and lately something that we're paying close attention to, as you would expect, what's going on around the world in currency markets, in fixed income markets, in equity markets, all of that. For me, though, my background was more in the private sector and as an investor, and for a significant
You
part
still
of my
are in the
career,
private
I
sector.
have to talk to outsiders about what they're seeing and what they're dealing with for it to really kind of fit together for me.
There's nothing
I can
federal
only
about
so
the
much data,
Federal Reserve.
and but to really get the story and the narrative, it's more talking to outsiders, and anecdotal data does help things kind of fit together for me, I would say.
Yeah, you told us about speaking with business people last night and getting a sense of what was going on in the Midwest. Let me turn to Fed independence. You've reiterated that you intend to stay in office until the end of your term, and that certainly reassured many in financial markets. What are the levers the government or the legislature have to pressure the Fed? And should one worry about threats to the Fed's independence once you're gone?
So our independence is a matter of law. Congress has, in our statute, we're not removable except for cause. We serve very long terms, seemingly endless terms. So we're protected in the law. So Congress could change that law, but I don't think there's any danger of that. Fed independence has pretty broad support across both political parties and in both sides of the hill. So I think that's not a problem. There's a Supreme Court case people will have read probably in today's journal at which the Supreme Court may decide whether independent agencies generally, whether they're authorizing laws, can contain a provision that prevents the president from firing members of a commission other than for cause. And that's a case that people are talking about a lot. I don't think that decision will apply to the Fed, but I don't know. It's a situation that we're monitoring carefully. Generally speaking, Fed independence is very widely understood and supported in Washington, in Congress, where it really matters. And the point is, we can make our decisions, and we will only make our decisions based on our best thinking, based on our best
This is a big lie.
data about what what is the way to to achieve our dual mandate goals as we can to best serve the American people. That's the only
It's a
thing we're ever
complete
gonna
lie.
do. We're never going to be influenced
They
by
do not
any
care about
political
the
pressure.
American people.
People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of
gosh,
political or
dude.
any other extraneous factors.
It's hard to watch, and then it's also hard to hear people clap for that.
Well, I have time for one more question. I know the question that's on all your minds. What are you going to do on interest rates next? But I'm not sure that you know, and I'm not sure you would tell, even if you knew. So I'm not going to ask that question. Well, the question I want to ask is a more personal one. What is it that you like to do most at home after an exhausting day flipping coins in the office?
You know, I play one of my guitars. I do Zoom calls with my kids and my grandkids, and I go to the gym a lot too, just to stay in shape.
We
All
need
those
you
things.
healthy. We
Yeah.
need you healthy. Thank you very much, Chair
Thank you.
Powell.
Thank you.
And please join me.
What a waste of time. All right, let's just let me just share the screen here. Let's go ahead and just go to the charts here. Yeah, so the S&P 500 started to sell off a little bit from there. It's down on the day, negative 237 basis points. Bitcoin staying pretty resilient here, although it's kind of similar, looking at how it's bounced on lower volume here. But yeah, I mean, from what I gathered, it's just the Fed doing their same old tune. The Fed, in myself and my team's view, is that they are a completely evil entity. They are definitely not for the American people. They're not part of the government. I can't believe he can just go on there and just say those lies to people and they just eat it up. Like it's just like Missy Lane says, it's very Hunger Games vibes, right? And they really don't have a model for, modeling the economic conditions. They're just reactionary. And, it is unsettling, just seeing that. And, yeah, I think it's just an evil entity. It's the reason why we have these boom and bust cycles. Like the interference of the central bank is the reason why we have these crazy cycles in the market. And so, yeah, I mean, they're just going to keep reacting. They're going to keep lying to the public. Hopefully people who are watching it here aren't falling for it. But yeah, we could see an increased acceleration in this decline for a second leg here in the S&P 500, as we see volume has completely dropped off on this bounce. And when volume starts to accelerate here, which will happen pretty soon, that's going to be the tell. And it remains very much in bearish trend. But from there, if you guys have any questions, make sure to leave those in the comments below. If you'd like to incorporate more of this macroeconomics into your process, as well as get daily exclusive videos from myself pre-market on the way that I'm positioned, as well as start to learn macro so that you can incorporate this for yourself, I would highly recommend going to our website here. This is our school community, which for those on YouTube, you can see the link for that in the description below. For those who are on TikTok as well as Instagram, you can go to the link in my bio and you can start your 7-day free trial. So, we have the entire, 14 chapter course in there. We have all of the things that, I've learned across the years to really help save you time. Everything's in one spot and you get daily reports, all that stuff. Again, 7 days for free, no commitment, but that's what I would recommend you guys start if you guys want to start incorporating macro more seriously into your process. But I appreciate everyone for joining. Good luck out there, and we will catch you in tomorrow's Daily Macro Update Live. Bye.